happened in 2020, financial crisis, lockdowns, and then bam, like that day, they printed up like $500 billion in the repo market, and all of a sudden the money supply started to just go vertical. It's going to happen again this time, but even more extreme. And it's going to be sometime in the middle of the night, and there's not even going to be a press conference about it.
Welcome to Silver News Daily, your ultimate destination for all things precious metals. If you're passionate about the glimmer of silver and the world of precious metals, you're in the right place. By hitting that magical subscribe button, you're joining a community of like-minded thinkers who see the potential of silver and precious metals shaping the future. Buckle up, because we're diving headfirst into the latest news and updates. Welcome back to our financial deep dive. Something's brewing in the world of precious metals. After a series of unexpected turns and whirlwinds, gold is on the cusp of what many believe could be a historic resurgence. The price, the implications, the undercurrents leading to this moment, all will be revealed shortly. Fasten your seatbelts as we embark on this golden journey. Gold. The allure of this timeless metal has captivated civilizations across millennia, making it the cornerstone of wealth and power. But like the grandest of stories, gold has its ups and downs. Let's dive deep into the currents of recent events. It's no secret that gold has faced a downwards trajectory, witnessing an uninterrupted slide for 7 consecutive days. Just last Tuesday, it slipped to a price reminiscent of early March. What caused this dip? Multiple factors. Top on the list is the Federal Reserve's recent decision. After warning about persistent inflation, they hinted towards a potential interest rate hike, possibly not just once, but multiple times this year. It's a move that naturally makes investors jittery, shifting their focus to assets that might yield better short-term returns. Adding to the precious metals' woes are the strong macroeconomic data coming from the United States. As these positive indicators stream in, there's increased speculation about further policy tightening by the Federal Reserve. The ramifications of this are twofold: a surge of the U.S. Treasury bond yields and a consequent bolstering of the U.S. dollar. The latter has risen to a peak not seen since late 2022, driving investors away from the non-yielding yellow metal. But it's not all doom and gloom for gold enthusiasts. A glimmer of hope emanates from the equity markets. With a generally weaker tone surrounding equities, the precious metal, known for its safe haven status, finds some footing. This is especially crucial given the oversold conditions it currently faces. However, analysts and experts agree the path of least resistance for gold, at least in the future, seems to be on the downside. But in the world of investments, as we all know, things can change, and they can change fast. We must also pay heed to the voice of the Federal Reserve officials. They've consistently highlighted the need for restrictive monetary policies. Their target? To rein in inflation and bring it back down to the ideal 2%. Leading voices like Fed Governor Michelle Baumann have shown a willingness to further raise rates if data indicates inflationary trends stalling or moving too sluggishly. Vice Chair Michael Baer and Cleveland Fed President Loretta Mester echoed these sentiments, emphasizing the critical importance of higher rates to ensure the disinflationary process continues. Amid all this, the U.S. ISM manufacturing PMI has marked a consistent improvement for 3 consecutive months, recording a high unseen since November 2022. Combine this with increasing consumer spending and the steady rise of gasoline prices, and we see a narrative building, one that underscores the potential for further policy tightening. To put it into perspective, the market is now leaning towards a 45% chance of another rate hike this year. Such expectations have shot up the yield on the benchmark 10-year U.S. government bond to a staggering 16-year peak. Yet, in this vast financial landscape, gold finds moments of respite, albeit brief. Bearish traders, despite their stronghold on the metal's trajectory, occasionally paused, especially in the current risk-off environment. This gives the traditional gold a momentary boost. But as we glance towards technical analyses, signals indicate caution. With a relative strength index, RSI, hinting at severely oversold conditions, many are waiting on the sidelines, anticipating a consolidation or a modest bounce. Yet the lack of buying interest suggests that this downtrend might not be over soon. Gold, a tale as old as time, often follows its own rhythmic dance, but it's also greatly influenced by economic and geopolitical currents. Technical analysis helps us decipher these rhythms, shedding light on possible future trajectories. Let's focus on the big picture first. Recent patterns have showcased gold's vulnerability to rising real yields. The ever-important 1800 level is now clearly visible on the horizon. This decline isn't random. A more hawkish FOMC dot plot sent tremors through the gold market, increasing the opportunity cost of venturing into this metal. In layman's terms, as real yields rise, gold's attractiveness diminishes. But for a genuine rally to form, a specific sequence of events would need to unfold. One pivotal factor would be the release of unfavorable economic data. This might sound counterintuitive, but consider this. If the data points towards a looming recession, it could prompt the Federal Reserve to reassess its stance and potentially cut rates. Such a move would invariably benefit gold, ushering in renewed interest. So, what does the daily chart tell us? Post the FOMC's more hawkish projections, there's been a sharp sell-off. It seems the Federal Reserve's announcement served as a wake-up call for gold enthusiasts. This downtrend appears to be aligning with rising real yields, a trend observed over the past months. But here's an important observation. The current price seems overstretched, especially when viewed in relation to the blue 8-day moving average. Historically, such discrepancies often culminate in a pullback, or at the very least, some consolidation. Zooming into the 4-hour chart offers further clarity. A well-defined resistance zone has emerged where intersecting factors like the downward trend line, previous swing high levels, and the 38.2% Fibonacci retracement level converge. For sellers, this presents an optimal risk-to-reward setup should prices retract to the zone. For buyers, breaking above this trend line is crucial, a feat that would signify a shift in momentum. Narrowing our scope to the 1-hour chart provides an even more granular perspective. Here, we notice a divergence with the MACD, typically a prelude to decreasing momentum. This could very well be followed by a pullback towards the 1875 resistance zone. Sellers might see this as an opportunity, while buyers would look for cues to target higher resistance points, particularly if the trend line is breached. In the week ahead, a slew of economic data releases looms large. Notably, the NFP report is on the horizon. Gold's reaction to these data points will be pivotal, setting the tone for subsequent weeks. Typically, gold tends to gravitate towards negative data, and a reverse trend is observed with positive indicators. So, where does this leave us? Gold, like all investments, thrives in uncertainty and volatility. It's a game of wait and watch of interpreting signals and making informed decisions. One thing's for sure, gold's dance is far from over, and we're all eagerly watching its next move. In a world of finance, forewarned is forearmed. The upcoming days are brimming with significant economic releases, each capable of influencing gold's trajectory. Here's a glimpse of what's on the horizon. Firstly, ISM Manufacturing PMI will be unveiled. Historically, this indicator has played a pivotal role in gauging the health of the manufacturing sector, offering insights into production levels, new orders, and inventory. A surge in this index could bolster the case for a strong economy, potentially tempering gold's appeal. Conversely, a drop might fan the flames of economic uncertainty, offering gold a lifeline. Following closely is the job openings data. Recall the last release? The notable miss led to a spirited rally as it hinted at less labor market tightness and, by extension, a less hawkish Fed stance. Should history repeat itself, gold traders might be in for a turbulent ride. Midweek brings with it the ADP report and the ISM Services PMI. Both are crucial barometers of the U.S. economy's health, providing cues on private sector employment and the non-manufacturing sector's activity, respectively. Strong readings could underpin the case for further rate hikes, potentially adding downward pressure on gold prices. But all eyes will be on Friday with the much-anticipated NFP report. Considered a bellwether for economic health, this report delves into non-farm payrolls, shedding light on the employment scenario. It's worth noting that this will be the only data the Federal Reserve will scrutinize before their next rate decision. A robust NFP reading could solidify the Fed's hawkish stance, potentially dousing gold's allure. On the flip side, a weaker report might fan hopes of a softer approach to rate hikes, lending gold a much-needed boost. In conclusion, the week ahead promises a roller coaster of emotions for gold traders. The interplay of data, sentiment, and geopolitical developments will cast their shadows, shaping gold's narrative. As always, it's crucial to approach the market with a balanced perspective, assimilating data and preparing for every eventuality. Disclaimer: the information provided in this segment is for educational and informational purposes only and should not be construed as financial advice. Always consult with a financial professional before making any investment decisions. If you found this content insightful, please subscribe to our channel for more updates and analysis.